What's going on, guys? Thank you for tuning in to this episode of Twin Finance. I am Jackson. Today we're going to talk about loans versus lines of credits. Also, if you haven't already, be sure to like the video and subscribe. Okay, so first off, a loan. The first big difference between this and a line of credit is you have structured payments. So we'll just write this, structured pay. So when you agree upon a loan, the bank say gives you $20,000. You're going to pay back monthly at this set rate. Right, at this set interest rate, and then you also have to pay back the principal. So within each of these payments right here, you're going to have interest charges, plus you're going to have principal repayment. So those are your two those are like the two breakups of your payment for a loan. If we go over here to a line of credit, basically you say you got a line of credit for $20,000. You don't have to pay anything until you actually use that money. So they're basically saying here's $20,000 if you need it, but you don't pay anything until you actually use it. So say you got something $10,000, right? Well, now you have to pay interest on that $10,000 that you actually used. So you have a payment that's basically, it's not structured at all. It's only once you use it. So if you take out a line of credit for $20,000, you might never use it. You might never make a payment. But if you do use it, well, then that's when you start making payments. So we'll call it just pay as you go. Basically, we'll call it pay as you go. Pay as you go. And the thing is with this payment, it's only interest. So it's only interest like that you have to pay. You can repay the principal at any point, at any set interval, any given amount of money you want to put on the principal of that loan. As long as you owe them $10,000, you have to pay the interest on that $10,000. So say it was 8% interest rate, whatever, so that's $800 you got to pay that person. So basically that's how you break down the payment of a line of credit. Another difference primarily is these are typically lower interest rates because the bank they have more certainty of when they're actually going to get their money back. They got all this stuff set up, so it's easier to get lower interest rates. The bank knows like they're going to get their money back within a given period, so they offer lower interest rates for loans. So obviously over here we'll have higher interest rates for lines of credit, higher rates. So that's another key difference between the two. The third difference I would say also is a loan is like you kind of like basically with a loan you have to tell the bank what it's for, right? Like it'd be car loan or this type of loan. With a line of credit, you don't have to tell the lender of the money what it's for. You just get that money, you spend it. Like, so I mean, really, if you want to spend it on drugs, like I'm sure you could find a way to do that. I'm not going to recommend that, but with a loan you can't say, hey, I want this loan for drugs. So you know what I mean? So like that's another big difference between the two. So that pretty much wraps it up. Lines of credits, you apply for lines of credits. You obviously apply for a loan too. But basically for a line of credit, you just get approved for it. So like you get approved to spend this much money if you want to. The loan, they give you that money up front and say, okay, this is how you're going to pay me back. This is when we agree upon that. So that's basically the two big differences between the two. As long as you understand that, next time you're faced with a situation on what to do, you'll be able to understand the two key differences. So I hope you took some value out of this video. Remember to drop a comment, a like, subscribe. Thank you and have a great day.